Hello, traders. This is George with the Harmony Trading System, and today I'm going to talk about something really useful. How can we prevent ourselves from getting caught up in a bull trap or a bear trap? And most of the traders that struggle in trading uh, don't have that environment, how to define environment fairly clearly in their head. As a trader, I have three questions to ask. Question number one is, how do I define the current environment that I'm trading? Because based on the answer that I get from the market, I will use the right tool for the right type of environment that I'm trading. The second question is, what type of behavior am I looking for that's going to give me high probability? But there's more. It's the signal after that. So what signal am I going to take that is going to define the risk for me in such a clear way where I have a stop, I have a target, and I know why, when, and where this trade is going to be taken at a what cost. So understanding those three pillars is going to put you in the right place at the right time to take advantage of timing the market in the futures market in an effective way. So today we're going to talk just briefly about the environment. Okay. So that has to be, in my perspective, defined clearly. So let's take a look at a chart and see how that is getting done using the Harmony Trading System. Okay. So what we're seeing here is the price action that happened on October the 10th. And actually, we're going to see from October the 1st all the way through October the 10th. And that's going to give us multiple examples that we can take a look at and explain. Okay. So today the market opened up with a Globex at 282.25. Look at the current candle that we were in at that time at the open. Once the market opened, about 45 minutes into it, the market closed higher at 245. At that time, a lot of traders would look at this and say, oh, okay, the market, it ran up significantly and it's due for a retracement. But that's not necessarily how you define an environment. What is the current close of the 200 NT Rinko, which is the Ninja Rinko candle that we see right here? And we see that has closed higher. Okay. Typically, any trend in the market, 100% of the time, whenever you get a move in the market, and I mean it, 100% of the time, you will always have the 200 NT Rinko and the 100 NT Rinko in sync, meaning the current close of the 200 chart is in the same direction as the 100 chart. So that is the 200 right here, and the one that's moving right now is the 100. When both of them are in closed higher, or the prior candle closed higher, then that is by definition defining the environment to be long. If both of those candles are pointing lower, that is defining the market as a short environment. If one of them is long, meaning it's a green candle, and the second one is short, then that is market out of harmony, which means that the market needs more information, more time to digest the move and decide if it wants to go higher or lower. Okay. But from my perspective, I am consistently going to be going higher and higher and higher, and I'm looking for pullbacks as a buying opportunity. And that's what we've done in the room all day long, looking for that signal on the behavior and the signal on the long side, because we have defined the environment visually and consistently every single day. Whenever those two charts are agreeing and directional, that's the space, and that's the direction I will be going through. So I asked multiple traders in the room. I was like, okay, how you doing today? How you doing? The that the people that were in sync with this idea made money today. The people that went against it and felt like the market should be too high for this level and should be returning back to the reversion of the mean. And it's not necessarily a bad idea. It just, the method in which you apply your defining the environment was not right from their perspective. So they ended up trying to fade it, trying to go short, and the market just continued to go higher and higher and higher. Whenever you think the market cannot go any higher, it just keeps on going. The same thing applies for the market that's going short. It just keeps going past the capacity of most people to be comfortable with price action. It hits all the stops, and once all those stops are spent, then you get a reversal in the market. But you typically don't know where that's going to happen. So as a trader, I'm better off giving the market that space between the 82 to the 95, okay, about 70 points, and let it reverse, okay? And then I'm going to start looking for the shorts. And that by itself would have saved me a lot of money, or the traders that actually were fading earlier, it would have saved them a lot of money because we were just following this all along to the upside. So the first thing as a trader that we have to all get good at and consistently exercise is define the environment. You define it visually, and you have to I have to define it consistently every single day in the same way. I cannot use one method one day and use another method the following day, because that will lead to consistency. So as a trader, if those two charts are agreeing, I'm long. If both of them are agreeing on the basically closed lower, I'm going to go short. And if they're out of sync, one is long, one is short, I have two choices: be patient and wait till it gets back in sync, or there are some type of formations in which we can take scalping opportunities in an environment that looks like that. Okay. So save yourself the headache, the trouble of inconsistency. Adopt this idea. It will save you a lot of time, a lot of headaches, and it just gives you a consistent method of defining the environment, so you could use the right tool in the right place, so you could profit out of these price actions. Hopefully, this is going to help you, and we will see you on the next one.